Good afternoon, class. Today, we will talk about Chapter 12. Chapter 12 deals with international bond markets. More specifically, here are the topics to be covered. We will distinguish between foreign bonds and euro bonds. We will discuss the different types of instruments available in the bond market. We'll look at the distribution of bonds in terms of currency denominations, in terms of the nationalities of the bond issuers, and in terms of the different types of issuers. International bond market credit ratings. We'll talk about the euro bond market structure and practices. And finally, we will take a look at a few international bond market indices. So without any further delay, let's get started. Now, this Exhibit 12.1 in your textbook presents an overview of the world's bond markets. You can see that the bonds are broken down into whether they are domestic bonds or international bonds. Now, what is the distinction between the two? Domestic bonds are issued by a borrower domiciled within a country, denominated in the currency of that country and traded within the country. For example, if a Canadian firm issues a Canadian denominated bond traded in Canada, that would qualify as a domestic bond. Now, international bonds include foreign bonds and euro bonds. We would examine that distinction in detail in a few seconds. Now, at the end of June 2018, the face value of bonds, long maturity notes outstanding in the world, was approximately $114 billion. That's a lot of money. That is a lot of money. $114 billion. Now, what is the difference between foreign bonds and a foreign bond is offered by a foreign borrower to investors in a national market and denominated in that nation's currency. Here's a good example. A Yankee bond is a bond issued by a foreign entity, such as a bank or company, but is issued and traded in the United States and denominated in US dollars. For instance, company ABC is headquartered in France. If company ABC issues bonds in the United States that are denominated in US dollars, the bonds are Yankee bonds and are subject to US regulations. A samurai bond is a yen-denominated bond issued in Tokyo by non-Japanese companies and is subject to Japanese regulations. If this wasn't interesting enough, well, bond known as a bulldog bond. A bulldog bond is a pound-denominated bond issued in London by non-British companies and are subject to regulations. Not to offend anyone, well, no, not to leave anyone out in the cold, where we have another category of bonds, of international bonds, known as a panda bond. A panda bond is a Chinese renminbi denominated bond from a non-Chinese issuer sold in the People's Republic of China. The first two panda bonds were issued in October 2005 on the same day by the International Finance Corporation and the Asian Development Bank. That was in 2005. A Eurobond, on the other hand, a Eurobond issue is denominated in a particular currency but sold to investors in national capital markets other than the country that issued the denominating currency. For example, Dutch borrower issuing dollar-denominated bonds to investors, say for example in the UK or in the Switzerland or in the Netherlands. Okay, such a bond is going to be called a euro bond. Another example is, let's say a US company, issues yen denominated bonds to investors in, for example, France, Germany, or Greece, or any of the European countries. That bond is going to be called a euro bond. Now we distinguish between bearer and registered bonds. Euro bonds are usually bearer bonds, bonds in which ownership is demonstrated through possession of the bond. You have to have physical possession of the bond. That's why it is referred to as a bearer bond. You need to have physical possession of the bond. The issuer does not keep any records. The issuer of the bonds does not keep any record of bond. Bearer bonds are very attractive to investors desiring privacy and anonymity. One reason for that is that they could allow them to evade taxation. Then we have registered bonds. Registered bonds, on the other hand, are bonds whose ownership is demonstrated by associating the buyer's name with the bond in the issuer's records. U.S. security regulations require Yankee bonds and U.S. corporate bonds sold to U.S. citizens to be registered. Let's comment a little bit on national security regulations. Now, foreign bonds must meet the security regulations of the country in which they are issued. As such, Yankee bonds must meet the same for to UK regulations. Okay. Many foreign borrowers find this level of regulation burdensome and prefer to raise US dollars in the Eurobond market. Transactional restrictions prohibit offers and sales of Eurobonds in the US or to US investors during a 40-day restriction period that allows for the security to become seasoned in Rule 415, instituted by the Securities and Exchange Commission in 1982, allows for something known as a shelf registration. Now, what is it exactly? What is a shelf registration? A shelf registration is a practice whereby an issuer can pre-register a security issue and then shelf the securities for later sale when financing is actually needed or when market conditions are more favorable. Now, a qualified institutional buyer in United States law and finance is a purchaser of securities that is deemed financially sophisticated and is legally recognized by securities market regulators to need less protection from issuers than most public investors. Now, why is this important? Well, Rule 144A, instituted by the Securities and Exchange Commission in 1990, allows qualified institutional buyers in the US to trade in private placement issues that do not have to meet the strict information disclosure requirements of publicly. So in order to participate in the private placement of these securities, you have to be a qualified institutional investor as defined earlier. Global bonds. A global bond issue is a very large bond issue that would be difficult to sell in any one country or region of the world. Global bond issues were first offered in 1989. They are simultaneously sold and subsequently traded markets worldwide. They must have been denominated in the US dollar. Now, the portion of a US dollar global bond sold by a US borrower in the US is classified as a domestic bond, and the portion sold elsewhere is a euro dollar bond. Now we'll focus on the different types of instruments available in the bond market. Okay, we have straight fixed rate issues, we have euro medium term notes, we have floating rate notes, we have equity related bonds, we have dual currency bonds. We will examine each of these. But here are the typical characteristics of international bond market instruments. You have a straight fixed rate bond. The frequency of interest payments is size of the coupon payment is fixed. Okay. Payoff at maturity is in the currency of issue, and that's how you can interpret the remaining bonds here, right? For example, a straight fixed rate bond with equity warrants. Again, the frequency of interest payments is usually annual. The size of coupon payments is fixed. The payoff at maturity is in the currency of issue plus equity shares from exercise warrants. Now, straight fixed rate bonds have a specified maturity date and fixed coupon payments. Unlike many domestic bonds which make semi-annual coupon payments, interest on your bonds is typically paid annually. The vast majority of new international bond offerings in any given year are straight fixed rate issues. Euro, US dollar, British pound sterling, and Japanese yen have been the most common currencies denominating straight fixed rate bonds in recent years, in recent memory. Euro medium term notes. Euro medium term notes are typically fixed rate notes issued by a corporation with maturities ranging from less than a year to about 10 years. Euro medium-term notes have a fixed maturity and pay a coupon interest on periodic dates. Unlike a bond issue in which the entire issue is a euro medium-term note issue is partially sold on a continuous basis through an issuance facility that allows the borrower to obtain funds only as needed on a flexible basis. These bonds were first introduced in 1986. Then we have floating rate notes. Floating rate notes are typically medium-term bonds with coupon payments indexed at some reference rate. The common reference rates are either 3-month or 6-month US dollar. Coupon payments on fixed rate notes are usually a quarterly or semi-annual and in accord with the reference rate. Floating rate notes were first introduced in 1970. You know. and they are an attractive option for investors with a strong need to preserve the principal value of the investment should they need to liquidate the investment prior to the maturity of the bonds. Another type of instrument found in this market is known as an equity related bond. And there are two types of equity related bonds. A convertible bond issue allows the investor to exchange the bond for a predetermined straight fixed rate bond value. The floor value of a convertible bond is its bonds with equity warrants. Okay. Bonds with equity warrants can be viewed as straight fixed rate bonds with the addition of a call premium or warrant. Okay, with the addition of a call option feature or warrant feature. Warrant A warrant entitles the bond holder to purchase a certain number of equity shares in the issuer at a pre-stated price over a predetermined period of time. Another type of instrument found in the bond market is a dual currency bond. A dual currency bond is a straight fixed rate bond issued in one currency that pays coupon interest in another, considered a dual currency bond. For these bonds, coupon interest is frequently at a higher rate than comparable straight fixed rate bonds. The amount of the dollar principal repayment at maturity is set at inception. Now, frequently, the amount allows for some appreciation in the exchange rate of the stronger currency. Japanese firms have been known to be big issuers of dual currency bonds. And here we have the currency distribution of international bonds. The amounts outstanding are given in billions of US dollars. You can see that starting at around 2015, the bulk of these bonds were denominated in US dollars. The euro, it was $8 billion, and from that point on, you can see again that difference is there. In other words, most of the bonds are dollar denominated. Now, here we're looking at international bond amounts outstanding, classified by nationality and type of issuer. Again, these statistics are in billions of US dollars. Uh, Australia is right here. Uh, and then if you come all the way down here, you see the United States. Okay. The United Kingdom seems to issue a lot of bonds. You can see here. Okay. And at the bottom, right, financial corporations, general governments, international organizations such as the International Monetary Fund, and so on and so forth, non-financial corporations. Now, international bond market credit ratings. Now, bonds have to be rated, and the three main rating agencies are Fitch Ratings, Moody's Ratings. S&P provided credit ratings on domestic and international bonds and their issuers. Ratings are based on an analysis of current information regarding the likelihood of default and the specifics of the debt obligation. Ratings also reflect both the credit worthiness and the exchange rate uncertainty. This is the S&P's sovereign rating framework. So the S&P starts off by looking at 5 key areas in order to determine a sovereign's credit worthiness. They look at the institutions, right? They look at the strength of the institutions. They look at the economic environment. They look at external factors. They look at the fiscal stance. Two areas here would then lead to an institutional and economic profile. And the last three here would lead to a flexibility and performance profile. When you put the two together, you sort of get an idea on sovereign indicative rating, right? And then you keep working your way down. So I'm sorry, the connection is very poor today. Now, Eurobond market structure and practices. Now, in the primary market is where these bonds are sold for the first time. Okay, so if you need to again issue bonds for the first time, you turn to the primary market. Okay, a borrower in this market decides to raise funds by issuing euro bonds to the investing public, right? They would contact an investment banker and ask it to serve as the lead manager, or also known as the book runner. Co-managers to perform, to form a managing group to help negotiate terms with the borrower, ascertain market conditions, and manage the issuance. The managing group with other banks will serve as underwriters. That is, they will commit their own capital to buy the issue from the borrower at a discount from the issue price. The discount, also known as the underwriting spread, is usually anywhere from 2 to 2.5%. The selling group would then turn around and sell the okay. This is a Eurobond tombstone, which is just an announcement, right? This exhibit here, exhibit 12.9, okay, presents a tombstone or an announcement for a dollar denominated Euro medium term note issue and the underwriting syndicate that brought the issue to market. Okay. You can see Merrill Lynch here, and then you can see other banks in the syndicate. Right? And this is the size of the issue. $2 million. No, $2 billion. I'm sorry. $2 billion is the size of this particular issue. Now, the secondary market is where those bonds that were issued in the primary market end up exchanging hands. Okay. So Eurobonds initially purchased in the primary market from a member of the selling group may be resold prior to their maturities to other investors in the secondary market. The secondary market for Eurobonds is an over-the-counter, OTC is over-the-counter. It's an over-the-counter market with the principal trading room located in London. It is comprised of market makers and brokers connected by an array of telecommunications equipment, electronic trading platforms, telephone lines, and so on and so forth. Market makers stand ready to buy or sell for their own account by quoting a two-way bid and ask prices. And they can trade directly with one another through a broker to market makers. What are the clearing procedures? In other words, when you sell a bond or when you buy a bond, how is that transaction handled? Well, Eurobond transactions in the secondary market require a system for transferring ownership and payment from one party to another. Two major clearing systems, Euroclear and Clearstream International, have been established to handle most Eurobond trades. Euroclear is based in Brussels and is operated by Euroclear Bank. Clearstream is located in Luxembourg and was established in 2000 through a merger Again, I apologize profusely. I don't know what is wrong with the internet connection today. Now, both systems operate in a similar manner. Each clearing system has a group of depository banks that physically store or keep bond certificates. Members of either system hold cash and bond accounts. When a transaction is conducted, electronic book entries are made that transfer book ownership of the bond certificates from the seller to the buyer and from the purchaser's cash account to the seller's account. A physical transfer of the bonds seldom takes place. Euroclear and Clearstream perform other functions associated with the efficient operation of the Eurobond market. For example, they finance up to 90% of the inventory that the Eurobond market maker has deposited within the system. They assist in the distribution of a new bond issue. Systems will take physical possession of the newly printed bond certificates in the depository. They will collect subscription payments from the purchasers and they will record ownership of the bonds. They also distribute coupon payments. The borrower pays to the clearing system the coupon interest due on the portion of the issue held in the depository, which in turn credits the appropriate amounts to the bondholder's cash Finally, we touch on international bond market indices. There are several international bond market indices, some of the best known being those produced by JP Morgan. Developed market indices include the following: JP Morgan Government Bond Index Series, the Economic and Monetary Union Government Bond Index. Okay. Those are two popular bond indices for developed markets. Now, as far as emerging markets are concerned, we have a couple of indices, right? So the emerging market indices include the following: the Government Bond Index Emerging Markets, the Corporate Emerging Markets Bond Index. So these are the two widely used indices as far as emerging markets are concerned. I really have to apologize for the poor quality of connection today, but I hope that I was able to get the main points across. As always, I ask that you please continue to be safe, continue to take care of yourself. Take care.